An average Jersey Mike store takes in about $1.4 million a year. Before the person who owns that store is paid a single cent, 11.5% of that money is already committed to somebody else. 6.5% is royalty. 5% goes to an advertising fund the owner pays into but does not control. Neither number is a rumor. Both are printed in the company's own registration statement, filed with the Securities and Exchange Commission on July 20th. That document exists because the thing collecting those percentages is being taken public. Not the stores. Almost none of the stores belong to the company. There are 3,378 of them across the United States and Canada, ringing up around $4.3 billion a year, and franchise owners built and run nearly all of them. What the company owns is the slice, and for the first time, the exact size of that slice, and every fee attached to it, is a public document anyone can read. So read it, because the same filing that shows a healthy, growing system also shows something stranger. Across the 6 months before this sale, the company's reported profit didn't rise. It fell by more than 80%. The store's own numbers say this model works. The company's own numbers went the other way. Start with the store, because that is where every dollar enters. To open one, the owner pays a $20,000 franchise fee, a $10,000 development fee, and then spends roughly $515,000 building it. Construction and equipment. That figure doesn't include training or the cost of opening the doors. Then the store starts selling. On sales of about $1.4 million, 6.5% leaves as royalty, roughly $89,000 a year. 5% leaves for advertising, roughly $69,000 more. Together, about $158,000 walks out of that register annually before the owner has paid for a single loaf of bread. What's left, the company reports, is a 16% store-level margin, about $220,000. But that 16% is not the owner's income. It comes before the loan payments on the $500,000 build, before the owner pays themselves, before tax. Measure it against the build cost, and you get roughly 42% cash on cash, exactly the return the company advertises to new franchisees. The math checks out. That was never the problem. You are not looking at a sandwich company. You are looking at a company whose product is a percentage. Customers spend about $4.3 billion across the system. The company books about $724 million. The difference isn't missing. It never belonged to the company. If breakdowns like this are your thing, the numbers that don't fit video go on Telegram, link below. Now hold on to that healthy picture, because this is where the filing turns. Store count up 8%, franchisee returns above 40, and in the first half of this year, reported net income fell from $73 million to a preliminary $12 to $14 million. Something expensive was being paid for. For most of its history, Jersey Mike's didn't sign up franchisees itself. It used a layer of people called area directors. Some were company employees. Others were independent operators, many of them franchise owners themselves. They recruited new owners in a territory and supported them. Site selection, training, operations. And they were paid for it. Not with a salary. The filing describes what they held with unusual precision. Contracts that mandated payment of a percentage of gross sales for a geographic region. Read that with a buyer's eyes. A percentage of gross sales, the same top line the royalty comes off. In those territories, the stream the company collects was never entirely the company's. Part of it stopped somewhere else first. Which is a problem, because you cannot sell a percentage whole while somebody else owns a piece of it, so it was bought back. On February 15th of this year, one area director agreement was terminated. On March 31st, a second. Combined cost, disclosed in the financial statements, $32 million. Across the first half of the year, area director buyouts came to a preliminary $51 to $53 million. The same line, 1 year earlier, was $4 million. Then comes the date that ties it together. As of April 10th, the filing says, one area director agreement remained, covering less than 1% of system-wide sales. April 10th is also the day the company filed the first confidential draft of the document that became this offering. 2 signatures, $32 million. And the paperwork starts the week the last one is nearly gone. Here the accounting matters more than the story. Those buyout payments are real cash, and they hit reported profit. But in Adjusted EBITDA, the non-standard earnings measure this offering is marketed on, they are added back and removed. So over the same 6 months, the two numbers separate. Reported net income down to a preliminary $12 to $14 million from $73 million. Adjusted EBITDA up to a preliminary $195 to $201 million from $163. In the quarter ending March 29th, the company reported a $24 million loss. Both sets of numbers are true. They answer different questions. One asks what the company earned. The other asks what it would have earned without the cost of buying its own royalty back. And the buyout doesn't only settle the past. The filing notes $14 million of lower expenses in that same half year, from retiring the old area director program in favor of internal staff. The advertising fund adds a second timing effect, and it runs both ways. In the second quarter, the company collected $3 million more than it spent, against $13 million a year earlier. Across the half, it spent $7 million more than it collected. Without those swings, the company says, Adjusted EBITDA would have grown 18% in the quarter. Underneath all of it sits about $2.1 billion of debt, and the collateral is the part worth hearing. Those notes are secured by all franchise agreements and area development agreements, the contracts themselves. The money was borrowed against the promises 3,000 store owners signed. The offering brings the company about $301 million, and $295 million of that goes straight back out to repay notes. As for the shares, $13.8 million are new. $29.7 million are being sold by people who already own them, about 68% of the deal. On those, the filing is blunt. The company will not receive any proceeds, which leaves one question worth asking. In 1975, a 17-year-old who worked at a sandwich shop in New Jersey heard the owner was selling. He borrowed the money from his football coach and bought it. Peter Cancro has been on the board ever since. He ran the company as chief executive from 2007. In January of last year, investment funds affiliated with Blackstone acquired a majority interest. 3 months later, in April, he stopped being chief executive. The filing states that sequence. It states no reason, and neither will I. But look at the arc it describes. A shop bought with a coach's loan becomes a system where opening one door costs $500,000, and 11.5 cents of every dollar that door earns is spoken for before its owner is. That is what's on sale. Not sandwiches, not the 3,000 stores. Other people paid for those, and other people run them. What's on offer is the right to collect a percentage of everything they sell, for a 10-year agreement that renews, secured by those agreements, and undivided again as of this spring. The stores were never the asset, the percentage was. If you want the next one, subscribe. And the numbers that didn't fit are on Telegram.